So it started off as with an opening gap to the week, and then 3 days of just absolute nothing burger before we finished the week with a little bit of a jump to the upside. So strong. We're on a very strong bullish trend right now. The question, of course, always is how much room do we have left, not just in the short term, but also in this intermediate run as well as a long-term run. So we look at different time frames as always in these videos to break down what our expectations are, and not just what they are based on the technicals of the chart, but then what do we do with that? So our trade idea of the day will try to reconcile this idea of where we're at right now, what our expectations are going forward, and how to manage the risks that are creeping in out there. So let's go ahead and get started. Today is Friday, December the 20th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. Let's start off taking a look at the S&P 500 with the Market Forecast Indicator. And you can see heading into expiration, just like we did in November. This is the second consecutive expiration cycle. And look how bullish that expiration cycle was in November. We followed up with a really bullish expiration cycle in December, so 2 straight months closing the cycle with a cluster on the S&P 500. This time, though, we ended up with a cluster with the market sentiment line. You can see this one did not. It was close. And heading into, we've had the last, going into September's and October's expirations, we had moves off of lows, and we finished closer to the highs of the cycle. So we've had a good 4 months where it's been pretty bullish, and that's brought this market sentiment line from its decline back now to overbought territory, which doesn't necessarily mean that we're going to drop. It just means that we're on a strong trend, needless to say. So good sign. Again, we are now, it's a little different here when we're just a month into, we were just barely a month into the intermediate run. Now we're over 2 months into an intermediate run. So now we're starting to get a little bit more mature in this run, and the longer the run gets, the more likely this cluster turns into at least a short-term exhaustion type signal, especially considering the gap and the small range that we had up today. We'll take a look at some other charts here in just a minute. Let's take a look how the weekly chart ended up. Again, following up last week's gap, or overbought cluster, on the weekly chart, we followed up with a higher high, getting considerably higher here. Here, let's get rid of this for a second. There we go. Getting up to a considerably higher high versus what we had on these two clusters, and really kind of negating this long lower shadow from a couple of weeks ago. And as I mentioned before, if I were to zoom out, a very similar run we're getting right now to come when we came off of this 2016 low point heading into 2017, where we got the turnaround here with a cluster, and then the pullback to the 200-day moving average, or in this case the 30-week moving average, 150-day, and then a bounce off of it with a cluster, and that's where we're at right now. And so this continued higher going into 2018, and we'll see if we follow up a really good 2019 with a strong 2020, which is seasonally typically the case. When you get 20+% returns, 25+% returns on a annual basis, it's not too common that we follow that up with a negative year. We end up usually with a positive year, and it's not too common that we end up with small positive years. So it's either going to be negative or it's going to be a pretty decent positive number, and that's what I expect going in. Even if, as we talked about in Friday's technical analysis class, with the cost basis now going into next year's year-to-date returns, with the basis being higher, don't expect 20% returns, because we only got that because the basis going into 2019 was really low. We had such a big down Q4 that set us up for a really strong return for 2019. Now, this doesn't set us up for a negative number in 2020, but it does set us up for a smaller return because our basis is higher now for any year-to-date returns we have going into for 2020 throughout the year. So, and then as we head into the end of December, this is what the monthly chart looks like. Again, we got a cluster in November on the monthly chart, and now we are closing with a higher high in December. So very strong 4-month rally here that we've had on the S&P 500 that has continued to produce or push higher. Again, similar to what we saw over here coming out of 2016's low, and we had a couple of clusters going into 2017, which ended up being a pretty decent year, similar to what we see coming here. So we've seen this type of pattern before, coming off of a global slowdown like we had in 2015 going into early 2016 that produced in the U.S. a death cross, and it produced one here at the end of 2018 as well in the U.S. So very similar patterns coming out of both time frames with very similar macro events that influence stock prices at the time. All right, let's go back to the daily chart and take a look at the Russell 2000, and you can see how bullish it is, and it's been more bullish than the S&P, and that's been a good thing throughout the week. The S&P has been pretty flat all week until this last little breakout on Thursday and Friday, and the Russell's been gradually moving up into, unlike the November expiration where we had moved up and then kind of were grinding into it, and you can kind of see a very similar pattern, and coming out of the expiration, some weakness. Don't be surprised if we don't follow that pattern and we come out of this expiration cycle with some weakness. But again, keep in mind that the market sentiment is above 80, which suggests a strong bullish trend, long-term trend. And as I mentioned before, I believe that we are, and you can see, we're just barely coming up above 50 on the Russell 2000. So it's, we are closer to the beginnings of, and I'll show this again later, but the crude oil has also been kind of a, crude oil has been has been moving in sync with the Russell throughout the year, and had a little bit of a pullback here on Friday. But you can see its market sentiment barely crossed above 50. So risk appetite really is just starting to take off when you go outside of the S&P 500. When you look at other asset classes, like you can see EEM is just getting from coming up from below 50. It's been below 50 for most of the year, and it's just starting to move up higher. The developed markets moved up higher a little bit earlier, and they're above 80 now, showing a strong long trend. But again, you can see the moves that these have had that the S&P has not. The S&P never did bring its market sentiment line below 50. So it looks like we've been, we're in a very mature long-term run, but the reality is that we're not. This was a pretty decent pullback from most of risk appetite asset classes, and we are starting to make a move, a long-term move higher here. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one down below the video, too, that will notify you when these videos are posted. Also, hit the thumbs up icon that's down below the video. That tells us two things. Number one, you liked our video. Number two, you want us to do it again on Monday. It's a quick way for us to get feedback. It's our only survey we have. So if you like our videos, let us know. If you don't, then you don't have to click anything. Also, while you're down there, comment. What did you get out of the video today? What stood out to you? What reactions, comments, questions do you have? Join our Market Scholars community. There's a link up there in the top right corner of your screen. Click that link to subscribe for free to our website. Follow me on Twitter for more content in between these videos from day to day. And join our Market Outlook Facebook group that we've created. Also, if you're on our site, watching the video on our site, we invite you to check out some of these other things here too. Check out our classes that we have. Here's our upcoming classes that we have for next week. We have 8 classes we teach every week. Our Plus subscribers get access to all 8 of those for $99 a month, and they also get access to our Market Outlook live videos. These are companion videos to these, where we manage all the trades that we do in each of these Market Outlook videos, that I do at least, from all the way to their close. So if that's something that interests you, I know it's been a very commonly asked for product. You can check that out there. That is included in your Plus subscription. Also, we invite you to engage with us on social media. Here's our Market Outlook tweet and Market Outlook Facebook post. Again, the more you engage with those, even just by clicking like this heart, for example, and then liking that, Twitter will now promote all our content to you because you engage with it. So we try to make it really easy for you. All right, back to the charts. So I'm going to take a look at the weekly chart for the S&P 500 and look at that nice, good bullish candle there. I mean, that's a nice, good, solid trend, and there's no sign yet of transition. And I would venture to guess, considering the midpoint of this range is going to be, the midpoint of that body is going to be the open for next week. And I don't think we'll get very much of a move here next week. But if you look at 3137.99 plus 3203.53, so the midpoint's at 3170. That's where next week's Hakinyashi Open is going to be on the weekly candle. We're currently trading at 32.21, so we're over 50 points above where the open's going to be. So we're going to have a pretty bullish candle this week too. So there's not going to be a reversal anytime soon. Even if we just have a down week this week, it will still be a pretty bullish Hakinyashi candle. So and which is the point of the Hakinyashi, is to smooth out the ups and downs and show us the trend or lack thereof. So very strong trend what we have going on here. If you look at the 3 green arrows for the SPX, here you can see, again, easily three green arrows, has been for a while. We had this little period of weakness where we don't have the green shading, where we had some red arrows, at least one red arrow. Obviously 3 red arrows is when you get the pink shading, but those can be, and the yellow line is when you're below a rising moving average. Those can be buying opportunities, as we frequently talk about here and look for in our directional option strategies class for good directional trades. That's really worked out for us. If you take a look at the 2-line versions for the S&P 500, look how we're easily above the 8-day moving average. Strong momentum. Stochastics buyers are in control. Again, we're overbought in the short term, but we're not. There's no imminent pullback anytime soon, at least in terms of a significant pullback. Maybe a near-term line dip below 50, but no intermediate line dip below 50 anytime soon here. Not until we get more of a convergence. We've had such a significant divergence on the MACD that we need these lines to converge with each other before we typically get more of a significant pullback. But that will most likely take place more into next year. Now let's take a look here at the intraday chart, and we'll see, look at the 4-week range. And again, very, very strong range here. Big move off of this low. You can see where the levels of support are. There's a pretty significant one here at 319, 317 after that, and all the way down to 314 is where our next layer of support. So it's, again, any significant pullback is going to have to break through a lot of these nodes, and it's got to do it one at a time, and most likely not going to happen there. If you take a look at today's volume and trading rate, look at the volume, big jump on quadruple witching, of course, but big jump in volume. You saw where most of it occurred here when you look at the intraday chart. A lot of it came here towards the end, coming into the close, where we had a little bit of a pullback here, but nothing too significant there. Again, don't read a lot into that, and I don't expect much of a move tomorrow or next week anyway during the holidays. That's why we take the time off here at Market Scholars between Christmas and New Year's, because there just isn't very much. Now, if there is, then I'll come on and we'll do a Market Outlook video and talk about it, like last year. But most years that's not the case, and so we'll probably just get some sideways action, consolidating some of these gains, but not with much of a pullback at all, if any. You take a look again at the trading range today. We were above average, and that average is really, really low, and so was the volumes again. So, but again, we'd have to get averages. We'd have to get moves above like 3.3. We have to get the ATR above 3%, for the above 3.2, excuse me, to start getting this above 1, to get above 1. So 3.2, and that's a 1%. So to get the ATR, we just have to start getting moves like in the 4-point range, and as long as they're in the 2.5-point range or lower, then perfectly fine. And you can see volume too. Again, if I give you some context in the past few years, we've really come down in the volume and the trading range. This is very bullish territory, and as you can see in other years, 2018 and even all 2017, you can be this bullish and this grinding for a long time. In fact, if you take a look at the trend strength indicator here that I like to show, here we go on the SPY, you can see we've crossed above 5 and 8. We have a very strong trend, but to give you some context on how long strong trends like that can last, there's the one at the end of 2017. Here's the end of 2016 going into the beginning of 17. And here is even the beginning of this last year. So you can have really strong moves that, once you get a strong trend developed, it can last for a while because of how strong the trend is. And so now that we've eclipsed that point and we're pretty solidly built, set up there, we can be here, and it'll be slow and it will be grinding, and there will be some near-term pullbacks and some intermediate lines pulling down below 80, but the mood going into next year, even though the basis is high, and we most likely won't get another 20+% return year, we'll definitely end up, I believe, with at least a double-digit return year. Because of how strong the trend is set up going into the year. Finally, let's take a look at volatility. And you can see volatility is in the bullish. It's not extreme, but it's in the bullish sweet spot. And we can see that's a good sign. The markets can be bullish for a while in that area. And so that's kind of what we want to see without getting too extreme, because extremes lead to pops in volatility. And we don't really necessarily want to see that. But we are in the bullish zone and the oversold zone for volatility, so it's not extremely oversold, but it is oversold. So any bounce, that would be associated with near-term pullbacks would most likely just get us into the upper half of this zone between 85 and 90. But that's fine, right? We've seen again where if I were to zoom out here, you can see periods where you can be down here in this zone for months, for multiple months. And I think that's the kind of area that we're at right now, where the short-term pops just get you up to 90, and that's it. All right, so what do you think? Do you agree with that technical assessment that we just came up with, or disagree? Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. It opens up a poll. You can hit either agree or disagree. If you disagree, comment down below on why. What are you seeing that would suggest either you're more bullish than we are, that we have more left, maybe even in the short term. I guess you can't be that much more bullish than we are. Or do you think that you're a lot more bearish? That maybe we're closer to the end of a long-term move than we are the beginning. And what are you seeing that would point us in that direction? And share that with our community, like I said, down in the comment section below. All right, now let's talk about what's driving the price action here, and let's move into how things performed. If you look over here on the right, you can see how things have been performing, not just on Friday, but also over the past 3 months. I've got it sorted, and obviously the VIX is down the most, but you can see long-term bonds, gold, real estate, the safety trade that for most of this past year has been the most bullish trade. As you can see, they've been the ones that up here the most. Crude oil is in orange, but you can see gold in red. Yellow was long-term bonds. They had a pretty decent move, and really, from, if you were to come from this low point or this peak, from this peak on May the 3rd, from May the 3rd, that's when the safety trade really took off. So go from May the 3rd of this year up until now. Put it on daily chart. So you can see we're still recovering from, look at this, a 15-20% moves off that May 3rd peak in equities. And you can see stocks didn't fall very much. Crude oil fell, and emerging markets fell, and small caps fell. They were down 7 to 10% at one point in time from that peak. even if large cap stocks are only down a couple of percent. But the reality is it was a pretty big bearish market, especially when you go from the high point on October the 3rd of 2018. That's when things peaked from the risk appetite trade, and we really had a decline. You can see these were up 25%, gold and long-term bonds. So you can see how we're still unwinding this extremely overbought safety trade, and since this October 8th low point and even through this week, we're really starting to move higher in risk assets. But they still got some room to go. 10 to 12, 14%. It's a pretty decent move, but you can see we're only down about 5% long-term bonds, and gold's down hardly anything at all. So there's still plenty of room to run. Just looking at this week alone here in December, here we are right there, and we'll just go from the beginning of the week. Now we'll go back to like a 15-minute chart here. Incidentally enough, small cap stocks had the best week. Remember, the market was flat for so long. Small cap started weak, and then they just gradually moved higher. Even if large cap stayed flat until the very end of the week when they had a little bit of a breakout. Crude oil also had a pretty decent week, pulled back at the end. Real estate finished pretty strong. You can see international stocks really struggled. Developed markets were down this week, and emerging markets were down for most of the week until the very end due to a stronger dollar. If you take a look at that dollar chart, which has been looking bearish and looking like it might roll over, well, we just had this week was a bullish near-term run. But we've had, if you look at this, we've had a little bit more context. We've had dark pink shading and a red line. We're on a bearish trend now. We've had light green shading and a glimpse of a yellow line there, and maybe a yellow line again. But remember, that's a bearish pattern when you've been on a bearish trend. So we'll see if that ends up being a reversal or not. And most likely it's appearing that there's an opportunity for the dollar to roll over. In fact, if you look at its weekly chart for the dollar index, you can see the bearish candles that we're getting. Now, we had the big body and the big shadow last week, and this week we stayed inside of it. So of course we need to get below 96.5, and we're a dollar above that for us. We'll see. Unlikely we'll get it this holiday week, but we'll see. We'll see what happens with that. If you take a look at the 10-year, but you can see that's where the trend is going. The 10-year yield, you can see, is moving higher again, which is also positive for the risk appetite trade. I mentioned I'd show you the crude oil trade. It's got the bullish crossover now in the 50 and 200-day moving averages, and you can see the bullish candles we've been having for a couple weeks in a row now on the Heikin-Ashi candle. So, crude oil is showing the potential for risk trade, and you can see we're just opening here. Crude oil is showing the potential for risk now to start moving higher. So the risk trade is making a run. It's making a run back finally to the upside, and like I said, according to this and according to the Russell 2000, it appears that we're closer to the beginnings of a breakout move. And when you look at other international equities too, like EEM, you can see just starting to break out there, and EFA having its own breakout just a little bit earlier, and they're not even close to those January 18 highs. Plenty of opportunity for there to be a long-term move in risk going forward from here, even if U.S. equities lag. And if the dollar drops, there's a good chance that U.S. equities will lag, just like they did in 2017, where international stocks did very well compared to U.S. equities. Now let's take a look at how the sectors have performed this week, the U.S. equity side of things. We'll take a look at the comparison first, and we'll take a look at that 12 grid. Let's go to December here. Go to the beginning of the week. We'll go to a 15-minute chart again. Communication services, our best performer. Interestingly enough, utilities and real estate were up, even though yields are continuing to make a run, continuing a trend at least to the upside. Healthcare also outperforming. the market this week. On the other end of the spectrum, previous strong movers like financials, industrials, giving back some of their recent gains. Technology matching the market. You can see staples and discretionary consumer stocks all down, lagging, and then also materials lagging behind, and energy. And again, energy started the week strong with that big move higher in crude oil early in the week. You would expect with the weaker dollar that those particular industries would do better. Now let's take a look at the 12 grid for the different U.S. sectors. You can see how you have your three cyclical kind of market risk appetite leaders are showing strong bullish patterns. Really, the only one that's not is industrials, because even utilities is back up above, strong green shading, 92 92nd percentile and above a rising green line. You can see real estate's kind of lagging behind too still, but they're staples, and healthcare and energy is above 80 on the intermediate line and above a green line. So pretty broad rally. Really only have real estate and industrial that are not participating to a degree in this big bullish trend. So when you also look at the foreign markets and how what their charts look like right now, especially the major ones, the biggest ones, you can see we have dark green shading and green lines all across the board. Only light pink shading in some of these developed areas, but showing bullish opportunities, 70, 72, 59 on the intermediate line. So they're weakly bearish at worst, and bullish bounce opportunities at best to rejoin where a lot of these emerging markets are showing, and even Italy in the U.S. with the overbought clusters showing on Friday. So for our trade idea of the day, we're going to try to reconcile this idea of being in a strong bullish trend, but concerned about how overbought we are in the short term and these really strong moves that we've gotten up into this expiration cycle, and how likely we are to continue that coming out of the expiration cycle, even coming out of maybe the holiday after we get through this holiday season. So you got a stock like Pepsi, which is starting kind of a nice, good bullish trend. It's a consumer staple, hasn't been going anywhere, but it's got a good bullish pattern here. Strong green shading, green line. You look at its long-term chart. You can see that it's you've got this strong momentum that's converging, but it's not breaking, and it's still bullish. You're still above a rising 50-day moving average, which itself is above the rising 50-day moving average. You take a look at its 3 green arrows, and obviously we have had some red arrows excuse me, during this little short-term pullback, but now it appears the histogram is starting to roll back up and potentially set for a new set of 3 green arrows. You take a look at some other of its kind of trending type charts, and you'll notice that we are above its Ichimoku cloud, back above its green line, which is also above its blue. You got the weak bullish trend developing here. You take a look at the Bollinger Bands. We are in the upper end of its bandwidth, above the point of control, kind of flirting with the point of control. We got very strong support below us. A little questionable about whether or not we're breaking out, and if and when we will, for a directional trade. But for a high probability trade, we might not know how much directional opportunity we have, but we do know we have very strong support below us. And that's what sets us up for selling this vertical spread at the 136, 134 vertical spread. You can see 136 is right where that point of control is. So as long as we stay above the point of control, then we'll stay above and get towards our maximum gain. If you notice, one of the ways we account for the risk of this short-term overbought condition is to trade smaller than normal. This is smaller than normal trade at the worst case scenario. Knowing that I don't want to lose $765. Remember, on short premium trades, we try to cap our losses to what we're trying to make. So if we're trying to make $235 and we're going to try to lose $235. But worst case scenario, if I can't, then I know at least I'll keep it to smaller than what my normal position size is. And that's how we'll account for the risk of short term, but still trading in the direction of the trend, because this is a bullish strategy, bullish option strategy to sell this put vertical spread. All right, so that does us for today. You've heard from me now. Now I want to hear from you. Use that link right there to go to our Market Scholars forum, specifically our Market Outlook forum, which is one of the things you get access to as a free subscriber to our site. Open up any new thread with any new questions or comments you have about what I talked about in today's video, or anything I didn't talk about that you want my take on, or you want to spark a conversation with other members of our Market Scholars community. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video below. Follow me on Twitter for more content in between videos from day to day, and join our Market Outlook community, or Market Outlook, a Facebook group that we've created, as well as our Market Scholars community at marketscholars.com. Have a great rest of your weekend, everybody. We'll see you all on Monday.